So we'll go ahead and get started. As I mentioned, I'm Jessica Ness, owner and Senior Vice President here at CJM. And we've got a great presentation planned for you guys today. I'll introduce my speaker in a moment, and he will spend about 45 minutes taking us through a presentation. Then we'll leave a few minutes at the end for Q&A. And my colleague, Parker Trasborg here, he will be collecting your questions along the way, plus anything submitted to us prior. So we'll try to tackle as many of those as we can. So let's go ahead and get started. Again, welcome. Thank you for joining us. We appreciate you guys taking time out of your really busy days. I know there's always lots going on. We value your trust, partnership. Just really thank you guys for joining us today. We're excited to welcome economist Dr. Anirban Basu from Sage Policy Group. We saw Dr. Basu most recently at one of our industry conferences, the FPA conference earlier this year, and he impressed us in his engaging and interesting presentation. And as you can imagine, that's high compliments, right, for economists that we run into. So, you know, as our clients know, we believe in education and awareness. And to that end, we invited Dr. Basu to speak with us today. Now, his presentation will supply in-depth analysis of the major factors shaping economic outcomes, including central bank policymaking, worker attitudes, business confidence, and geopolitics. Then it'll turn to a forecast for the years to come, highlighting the major risks that economic stakeholders will likely encounter. Now, Dr. Basu himself is a study in contradictions. He's been called an economist with a personality, which we've seen, or alternatively, one with a sense of humor. He has been twice recognized as one of Maryland's 50 most influential people. He's also been named one of Baltimore region's 20th most powerful business leaders. In 2014, Maryland Governor Larry Hogan appointed Dr. Basu as chairman of the Maryland Economic Development Commission, quite a mouthful, and he teaches global strategy at Johns Hopkins University and serves as the chief economist function for a number of organizations across the country. He has also read every one of Agatha Christie's novels, as an avid fan of James Bond, loves English football, Indian cricket, all Baltimore teams, as do I, and lives with his wife and two daughters, Kamaya and Kohena. Dr. Basu, thank you again for joining us, and take it away.
All right, let's do this. Thank you so much, both of you, Jessica and Parker, for inviting me. I'm going to share my screen as it turns out, and I'm going to go through some slides here. And as had been noted, please use that Q&A function to ask your questions. Obviously, I hope to answer some of your questions with respect to the economy as I go through the material, but please don't hesitate. Indeed, Parker and Jessica have told me that if there's a question that fits neatly with what I'm speaking about in that moment, they'll ask it while I'm going through the material. And I will leave some time at the end, parenthetically, for questions and answers. My presentation today is entitled Show Me the Money Supply. This is a Tom Cruise themed presentation. You will see that theming throughout the presentation, whether you like it or not. I hope you don't hate it, but it is firmly baked within the cake. This is Tom Cruise from the 1996 film Jerry Maguire, in which he plays the role of a sports agent with a single client, the fictitious Arizona Cardinals wide receiver Rod Tidwell, played by the actor Cuba Gooding Jr. In any case, it is not about Tom Cruise so much as the economy, but the question then becomes, why would an economist introduce the concept of money supply right from the get-go? The topic of the economy is vast. So why begin with money supply? Well, as it turns out, it's at the heart of the matter. Much of the data I will show you today are time series data. So the more contemporary data will be toward the right of the slide. This is money supply graph back to 1959. And again, focusing on the right side of the slide, you can see that during much of the pandemic recovery period, this phenomenal growth in money supply. This is engineered largely by policymakers, the Federal Reserve expanding the size of its balance sheet, flooding the banking system with liquidity, driving interest rates as close to zero as was possible to try to induce people to borrow more and spend more, borrow more and invest more, to countervail the worst effects of the pandemic on the economy. The federal government also is borrowing lots of money and spending lots of money in the economy. All of this inures to the benefit of money supply growth. And from the perspective of economic recovery, this absolutely works. By the second quarter of 2021, US gross domestic product is above its pre-pandemic level. So the pandemic undoes the economy during the spring of 2020. A bit more than a year later, we're back, at least along that dimension. However, that V-shaped, very rapid economic recovery brings with it a bout of enduring inflation. And the Federal Reserve, of course, has been contending with that for more than a year now. They've been raising interest rates until recently shrinking the size of their balance sheet, trying to reduce borrowing and spending, borrowing and investing to try to bring demand into conformity with supply to wring excess inflation out of the economy. So now money supply has been shrinking. You can see that here. So money is more expensive. Interest rates have gone higher, for instance. It's more difficult to access. We'll talk more about that. And when money supply is disappearing, that can create some pretty risky business. And one of the things we want to talk about are some of the risks inherent in the economy. And what's the culprit here? Why have we gone from a period of very rapid economic recovery from the worst days of the pandemic economically to speaking about the risk of recession in the next few months, or at least at some point in the next 12 months? Well, again, the culprit here is inflation. Now, we economists, when we talk about inflation, we tend to talk about it in the context of its effect on interest rates and Federal Reserve policymaking. And of course, as stakeholders of CJM Wealth Advisors, many of us are concerned about that, not just as economists, but just as stakeholders in financial markets. But there's another effect of this, of course, that's on households. Households are walloped by these inflationary pressures, and that, of course, has an economic impact as well. This is the US Consumer Price Index, 12-month percentage change. You see two lines here. The line in green is your overall rate of inflation, your all items consumer price index, which over the past year has run at 4.9%, past year ending with April of 2023. Now, the gold line is your so-called core inflation rate. That's all items less food and energy. Food and energy prices are notoriously volatile, but also susceptible to non-economic influences like Vladimir Putin, as it turns out, but also drought and natural disaster generally. So, for much of this pandemic recovery period, food and energy prices rising faster than most other prices. Now, food and energy prices have been, generally speaking, falling more recently. So after the outbreak of hostilities in Ukraine, oil prices were trading above $120 a barrel. Today, we're looking at oil prices in the low 70s, as it turns out. Egg prices have been falling since roughly December. I don't know how many of you have become engrossed in a conversation about egg prices this year, often with neighbors. And as you know, once you get involved in those conversations, almost impossible to extract oneself. Indeed, I delivered a presentation very early this year at the University of Delaware. The University of Delaware, of course, gave us the greatest quarterback in NFL history, Joe Flacco. But also their team name is the Blue Hens. They're the University of Delaware Blue Hens. And I looked those Blue Hens right in the face and I said, you ought to be raising chickens, you Blue Hens. And they also did not laugh at that. But the point is, egg prices were high, and so it made sense to raise chickens. But since that time, those kinds of prices have come down. So when you strip out food and energy prices, you get that core inflation rate. That inflation measure is actually higher now, 5.5% year over year. In any case, inflation is running well above the Federal Reserve's 2% target. So the war on excess inflation persists, even though the Federal Reserve has raised interest rates so significantly, and we'll talk more about that in a couple of slides to come. Now, again, there's a cumulative effect to this because households are getting waylaid by this month after month after month, these high prices. So if you were to compare the price level in May of 2020, why May of 2020? That's the first month of the economic recovery from the worst stage of the pandemic economically. So we lost those 22 million jobs as a nation in March and April of 2020. We start to add back jobs in May. So if you look at what prices look like in May of 2020 as the recovery commences versus April of 2023, the last month which you have data, you look at the headline numbers down below, all items consumer price index up 18% in less than 3 years. In a country that aspires to 2% inflation per annum, the so-called core rate of inflation down below, all items less food and energy, 15% inflation, again, in less than 3 years. The green color bars show you things categorically. So energy prices up 55%, used car and truck prices up 39% in less than 3 years. Transportation services, that includes things like airfares, up 27%. Tobacco and smoking product price up 22%. New vehicle product prices up 22%. So one of the worst things you can do is smoke in a new car, because it's bad for your health. It destroys the new car smell, but renders also one susceptible to all these inflationary pressures. And of course, if you're in Northern Virginia or in Baltimore, where I am right now, it's pretty smoky out there thanks to these Canadian wildfires. So probably just not a good idea to smoke generally. In any case, again, lots of cumulative effect here. Now, it is true again that inflation has dissipated more recently. So to go back to the previous slide, back in June of 2022, if you look at this, overall inflation was running at 9% year over year. Now it's down to 4.9%. So if I just show you the consumer price index for the period April of 2022 versus April of 2023, just last year, you can see again the headline numbers at the bottom of the slide: 4.9% overall inflation, 5.5% on the core. But you still see some lumpy inflation rates here. Transportation services, again, things like airfares up 11%, shelter and food price up 8%. And who does this affect the most, by the way? It's people with the lowest quintiles of income, people for whom food and shelter comprises a disproportionate share of their household budgets. And I think that's one of the reasons the Federal Reserve is so aggressive in trying to get us back to 2% inflation. They know that people in the lowest quintiles of income are most affected by inflation, including people on fixed incomes. Let's say people in their 70s and 80s, as an example. And so what do they turn to? They turn to their leading policy instrument, which is, of course, the Fed funds rate, the overnight bank lending rate, the rate at which banks can borrow from one another overnight. Why do they do that? To store up their reserves, because you need a certain amount of reserves in the bank to make loans outside of the bank. So you don't want to run up against that constraint to the extent that you want to make more loans. So here I'm graphing for you the federal funds target range upper limits. And I should point out that I did not create these slides. That was done by our economist, Sayer Niblett, who is a fabulous professional. But in any case, setting that aside, so the lowest upper limit you can get here is 0.25%. And coming into the pandemic, the federal fund rate was non-zero, but then the pandemic sweeps through the economy. The Federal Reserve lowers interest rates as close as possible to zero, which is 0.25%, since I'm graphing again the upper limit. It stays there for about 2 years. When inflation begins to blossom during the spring of 2021, they respond by doing precisely nothing. They presume that inflation is transitory. A synonym for transitory is fleeting. They think it's purely supply chain driven, that the economy was coming out of its doldrums, people were becoming vaccinated. We had this surge in demand, particularly for goods. But the supply chains had been closed to various degrees, varying degrees. And so supply was falling short of demand. That's inflationary. But as supply chains healed, as they normalized, supply would rise up to meet demand. Inflation would come back to its pre-pandemic 2%. Instead, what the Federal Reserve oversaw was the creation of a wage price spiral. So during the spring of 2021, prices take off. Employees say, my goodness, boss, look at this. Are you looking at the CPI data the way I am? Because I look at them all the time. They actually never had before. But setting that aside, are you looking at these data? I need a raise. It's getting very expensive to live out here. Boss says, no problem. Economy's coming back very, very quickly, a V-shaped recovery. And I'll just pass on my cost increases to my customers, because in an inflation environment, I can support higher profit margins. In fact, corporate profits are positively correlated with inflation. Well, of course, we get another burst of inflation, and now employee comes back knocking on the door. Boss, I need another raise. Okay. So now you're in the midst of a wage price spiral. The Federal Reserve, to get inflation back to its 2% target, has to break that wage price spiral. So that since March 16th of last year, they've been raising interest rates. First, they dipped their toe into the inflation fighting water, 0.25%. Then 0.5% the next meeting. Then 4 consecutive meetings of 0.75%. Back to 0.5%, then 0.25%, 0.25% again. Then on May 3rd, meaning a month ago, 0.25%. So what was a 0.25% rate of interest is now 5.25%. Now, most pundits, analysts, so on agree that the Federal Reserve will pause in June. So they meet June 13th, June 14th, and they will not raise rates this month. And we'll get into why that is. But interest rates are much, much higher. Now, ostensibly, they're not trying to destroy the economy. They're trying to engineer a soft landing. What does that mean? They want to frustrate borrowing and spending, borrowing and investment by driving up the cost of capital, bringing demand down into conformity with supply to wring out excess inflation. But the question becomes, is it possible at this point to engineer a soft landing, or is that mission impossible? That's really the question here. Now, the good news is that they still have some room to maneuver. The economy is not in recession right now. And let me talk a little bit about how they conceive of the issue. These two quotes come from our Federal Reserve Chairman, Jerome Powell, who back in August of 2022 says the following quote, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they'll also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. And for them, the definition of price stability is 2% inflation. So since they started fighting inflation, we could make the argument that they started too late, but since that battle has begun, they've been very aggressive in their language and their actions, words and deeds. And they've talked about raising interest rates, talked about fighting off inflation, and they in fact have raised interest rates quite significantly. In November of 2022, the Federal Reserve Chairman says the following, quote, let me say this, it is very premature to be thinking about pausing, even thinking about it. So people, when they hear lags, they think about a pause. What does that mean? So when the Federal Reserve raises interest rates, whether on March 16th of 2022 or May 3rd of 2023, the complete effect of that on the economy does not show up immediately. It takes a while to work through the economy. It could be as much as 18 to 24 months before an interest rate increase has its complete effect on the economy, which means even the March 16th of 2022 rate increase has not had its complete effect on the economy, let alone, let's say, the 4 rate increases of 0.75% apiece. So there's all these lag effects built up in the economy. So many stakeholders, including investors, would say to the Federal Reserve, slow your roll. What are you doing here? You've raised rates at the fastest pace in more than 4 decades. Let these lag effects wash through the economy. It'll bring growth down, bring inflation back down to 2%, your target, your mandate. You don't keep raising rates because you're going to drive the economy unnecessarily into recession. But the rejoinder to that comes from the Federal Reserve Chairman in the form of this third sentence. It's very premature. So in the span of 3 sentences, our Federal Reserve Chairman says the words very premature twice. Not especially eloquent, clearly not written by ChatGPT, but it makes the point. It's very premature, in my view, to think about or to be talking about pausing our rate hike. Now that was said 7 months ago. It's now June of 2023, and it is true that they're pausing in June because I think they want to see what these lag effects look like. They want to take a pause, but then they meet again in July. And the bond market is suggesting that maybe they pause in June, but start raising rates again in July. So we will see. But the war on inflation is not yet done. But again, the good news is there is some underlying lingering momentum in the economy. So as an example, the broadest measure of U.S. economic progress is growth in gross domestic product. Quarterly data, annualized rates of growth. Now, if you look at the left-hand side of the slide here, you can see the undoing of the economy for the first half of 2020, including that negative 29.9% performance for the second quarter of 2020. And then the V-shaped recovery, 35.3% during the third quarter of 2020. Several ensuing quarters of high single-digit rates of growth in an economy accustomed to growing 1.5% to 3% per annum. True. During the first half of 2022, America sustains a setback, 2 consecutive quarters of negative real GDP growth. The economy grew in nominal terms, but once you adjust it for inflation, it turns negative, satisfying a technical definition of recession. But then the third quarter bounced back, 3.2%, 2.6% to conclude last year, the fourth quarter of 2022. During the first quarter of 2023, the U.S. economy grows 1.3%, which sounds pretty weak, and it was, but misleading, because a lot of that was about inventory decumulation, which really pushes the gross product estimates around. But consumer spending was still pretty strong during that first quarter, consumer spending growing at a 3.8% annualized pace during the quarter. Now, the Atlanta Federal Reserve maintains a product known as GDP Now, which estimates current quarter gross domestic product. And that estimate right now sits at 2.0% for the current quarter. None of these are indicia of recession. And indeed, there are certain parts of the economy that have been especially strong, including, as it turns out, the consumer. Here's U.S. retail sales. Monthly data, and these are monthly data, stretching to April of 2023. And you can see the consumer has been on fire, is spending massively. And it's true that in November and December of last year, retail sales slipped. So retailers came into 2023 with plentiful inventory. They discarded that merchandise aggressively. right, after the holiday shopping season. Sales took off in January, but then fell again in February and March. More discounting. Sales come back a bit in April. We'll come back to this. But in general, the consumer has been spending pretty aggressively, wouldn't you say? When we look at this from a historical perspective. The consumer has tended to stare inflation right in the eyes and spent right through it. And I'll give you an example. I mentioned that transportation services has been a source of significant inflation in recent years. Airfares during a recent 12-month period rose 17.7%. Now, I've been told by the folks at CJM, you're speaking to a group of very successful people, not only our own staff members, but people who are with us as clients. And because they're successful people, Anirban, when they board an airplane, they tend to be island window people. And that's who you are. You're successful people, so you're island window people. That's who you are. And when you get into your island window seat, there's only one thing you're hoping, you're praying for, and it is not the safety of the flight. It is not that, because you presume the safety of the flight. That's incidental. No, the only thing you're hoping for in that moment in economic history is an empty middle seat. That's all you want. That's all you care about. And you don't have to feel embarrassed by that. Wanting an empty middle seat does not make you a bad person. It doesn't make you a good person. It doesn't make you a bad person, but the middle seat has been full because the consumer has been spending, and you can see that in the form of lengthy security lines, so on and so forth. So, the consumer has been spending, and yes, supported by stimulus payments and accumulated savings during the pandemic. They didn't take vacations then, so they had more money later on, all that, but also supported by a very strong labor market. This is net change in US jobs, monthly data. We've been adding jobs ever since December of 2020, a month during which it was COVID intensive, as it turns out, and also pre-vaccination. We just got the data for May. In May, America has 339,000 jobs. The unemployment rate is 3.7%. And I will give you a forecast, my forecast, later in this presentation. But I got to tell you, the economy has not worked out the way I would have expected in many cases. I'll give you an example. If somebody had told me back in February of 2022, anybody, here's what's going to happen. On February 24th, the Russians are going to make a move on the Ukrainians. Natural gas and oil prices will skyrocket, along with fertilizer prices, cooking oil, those kinds of prices. And then the next month, the Federal Reserve will start raising rates at the fastest pace in more than 4 decades. What do you think is going to happen with unemployment, Anirban? Now, at that time, March of 2022, the unemployment rate was 3.6%. I'm skeptical that I would have said it's going to rise maybe to 3.7%, but that's what's happened. The economy has been incredibly resilient in the face of war and higher interest rates, higher cost of capital. And bank failures like Silicon Valley Bank, March 10th, Signature Bank, March 12th, the issues at First Republic Bank, which was taken up by JP Morgan. That was your 14th largest bank in the country. Silicon Valley Bank was 16th. So Signature Bank was 19th. So lots of headwinds out there, lots of job growth. And here's the thing. As many people as American employers have collectively hired, they want to hire even more. According to the JOLTS, the Job Openings and Labor Turnover Survey, in April, 10.1 million available unfilled jobs in America. About 1.7 job openings in this country for every unemployed American. America is still very much the land of opportunity. You want a job in America, there's one waiting for you. In fact, there are two. Well, that's inflationary. You got 3.7% rate of unemployment, 10.1 million available unfilled jobs, almost 400,000 in construction as we try to rebuild the nation's infrastructure. All of that's inflationary because people are scarce, and that puts upward pressure on wages. And the problem here is not simply a cyclical one. It's not simply the fact that we've come out of the pandemic so aggressively from an economic growth perspective. It's a structural one. The labor force is not growing rapidly enough to accommodate the needs, wants, aspirations of the people of this country. And the real problem here is it's men. Men are the problem. Now, some of the women in the audience might say, well, that's a general proposition, sir. I'm only talking about the labor force dynamics, not household chores or anything else. So if you were to look at labor force participation rates in 1980, when music was good, versus 2023, this is what you get. So you're part of the labor force, you have to be either working or looking for work. So I'm looking at the proportion of the eligible population that's either working or looking for work, and then taking a delta between the proportion in 1980 versus 2023. So you look at the tabular data here, you see that top row there, which is also the bolded row. That's, to be part of the US labor force, you have to be at least 16 years of age. In Canada, it's 15, here it's 16. So labor force participation rate between 1980 and 2023 fell 1.2 percentage points, but it fell 9.4 percentage points among men but rose 5.7 percentage points among women. So men jumped out of the labor force, women jumped in. Now you can break this down by age. 16 to 19-year-olds, negative 19.5 percentage points overall, negative 23 percentage points for men, negative 60 percentage points for women. What's that about? That's college. So you might remember in the 1970s, we lost a ton of manufacturing jobs in this country. The notion was that we were going to become an increasingly service sector-oriented economy, which proved to be true. And to participate at the commanding heights of that economy, one would have to be quite gainfully educated, college degree, for instance, to become an engineer, a lawyer, a financial advisor, an economist, whatever it happens to be, an accountant, an actuary. And so if you're in college, you're less likely to offer your services to the labor force. 24-year-olds, negative 5.6 percentage points overall, negative 13 percentage points for men, positive 1 percentage point for women. What's that about? Well, it could still be college. It probably takes most guys 6 to 8 years to finish college. But then you look at 25 to 34-year-olds, positive 3.6 percentage points overall, negative 6 percentage points for men, positive 12.6 percentage points for women. What are these young men doing? Well, what are they up to? They're neither working nor looking for work, and they're 25 to 34 years of age. What are they doing? No one really knows because everyone's too scared to ask. But it probably involves a couch in a parent's basement, maybe some video games, who knows? But not work at a construction job site or an Amazon facility or any other place. And you might say, Anirban, look, I'm pretty sure that CJM invited you to be an economist, to be unemotional, dispassionate, data-driven. You're getting angry out there in computer land. You're getting pretty emotional. You might say to me, Anirban, the idea of a 33-year-old American man sitting in his parents' basement playing video games while eating bologna and salami sandwiches that his parents made, maybe smoking some weed, that's adorable. I don't disagree. I think that's adorable. But less adorable when they're 43. 35 to 44-year-olds, positive 3.7 percentage points overall, negative 5 percentage points for men, positive 11.8 percentage points for women. So, it is often said, by the way, that men make more than women, which is true as it turns out. Men make more than women still, statistically speaking. But young men do not make more than young women, and young women are far more likely to own a home than a young man. And so this is part of the challenge here, particularly for industries that are male-dominated, like construction, 87% male, manufacturing, 70% male. Because it means, more labor market tightness, it puts upward pressure on wages, that's inflationary. And here's the thing, this gives you some sense of how hot the economy remains. Even though American employers have hired so many people, again, we've recovered fully along this dimension, they want to hire even more. If you were to compare job totals for this nation in February of 2020, why that month? That's last month before we shut down the economy, versus May of 2023, last month for of data, America's up 3.7 million jobs. So we've recovered. The top segment here is professional business services. That's your law firms, your accounting firms. Many white-collar jobs are allocated into those segments. So it's a very large part of the US economy, which helps explain part of its primacy here. But also, disproportionately, it offers the opportunity for people to work remotely. And that's what many Americans want. They want to work remotely. A recent survey indicates that 68% of Americans, more than 2 in 3, want to work remotely, not at a job site. They don't want to commute. They don't want to be with their colleagues. They do not like their colleagues. A separate survey finds that 57% of Americans find their colleagues to be annoying because they overshare, meaning I asked you what you did this weekend. I did not intend for you to answer. They take credit for one another's work, but the number one reason people find their colleagues to be annoying, they interrupt during meetings, which can happen on Zoom, as it turns out, it typically does. Nonetheless, there is this general preference for remote work. At the bottom of the list, leisure and hospitality. That's your hotel and restaurant worker by and large. It's the lowest wage segment of the economy, so often outcompeted for human capital along the dimension of compensation, but also as a general proposition does not offer the opportunity for people to work remotely. Now, these labor shortages have been even greater in regions of the country that have been growing with particular pace. This is employment growth for the 25 largest metropolitan areas in our country. February of 2020, again, the last month before we shut down the economy, versus April of 2023, the last month which are these subnational data. Notice the primacy of the American South. And we've got people on this call from all over the country, but notice the primacy of the American South. Dallas, Tampa, San Antonio, Orlando, Charlotte, Phoenix, Atlanta, Riverside, California, Houston, Miami, San Diego. That's where the job growth has been fastest. That's where the population growth has been. That's where the job growth has been. Now, Philadelphia sneaks into that left-hand column, but for the most part, the Northeast corridor is in the right-hand column. You can see Washington and Baltimore, and several of us from Washington and Baltimore here, among the least dynamic economically in terms of job growth over the last 3+ years. You can see New York and Boston also in the right-hand column, along with the Midwest. So Chicago, Minneapolis, Detroit, St. Louis in that right-hand column, slower growth. That's not where the population growth has been as rapid. That's not where the job growth has been as rapid. Now, I find this slide to be interesting, but the next slide is far more important macroeconomically and from an investor perspective. Same 25 major metropolitan areas, but instead of percentage job growth, it's unemployment rates. And here's the problem, these unemployment rates are too low. You say, Anirban, that's crazy talk. We love low rates of unemployment. We love it when people graduate from an apprenticeship program, high school, college, and can quickly secure opportunity. We love it when somebody loses a job through no fault of their own, let's say, and can quickly find replacement employment. Yes, we view it as a sign of national economic strength, economic vigor. But it's less positive when you've got 10.1 million available unfilled jobs and inflation is still raging across the countryside. Because the Federal Reserve looks at these data and says, I can't stand by this. I can't allow this equilibrium to stand. Because I'm seeing wage growth between 4 and 5% because the labor market is still too tight. There's too much demand for workers. And to get back to 2% inflation, I might need maybe 3 to 3.5% wage growth, but I can't deal with the wage growth now. Somebody has got to lose their job. This labor market has got to be loosened up. And so when the Federal Reserve Chairman said back in August, I'm going to cause some pain to households, that's what he's talking about. And so the war on inflation is not yet done. Interest rates are already high and could rise further. And that dynamic, along with some other things we can talk about, increases the risk of recession. Again, 1996, Jerry Maguire, I cried. I wept. Now, before I talk about the likelihood of recession, let me define it for you. I had mentioned a moment ago that we sustained those 2 consecutive quarters of negative real GDP growth during 2022's initial half, satisfying a technical definition of recession, but not the definition of recession. This is the definition. The National Bureau of Economic Research's Business Cycle Dating Committee is the official recession scorekeeper. They're the arbiter of when recessions begin and if they occurred at all. And accordingly, they're the ones that maintain a chronology of US business cycles. So they're the ones who told us in 2002 that the recession of 2001 began in March of 2001 and ended in November of that year. Their traditional definition of recession is, quote, a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Except the recession that they declared in 2020 begins in February of 2020, ends in April of 2020, arguably not more than a few months. They declared it a recession nonetheless because, again, they can do whatever they please. They sit in Cambridge, Massachusetts, and they can do whatever they please. They are the definition of recession. And what's more, there is no fixed rule about what indicators contribute information to NBR's process or how they are weighted in the determination of recession. They can look at wherever they please. They can, now, as a practical matter, they look at employment, unemployment, gross domestic product, industrial production, retail sales, but they can look at it whatever they please, stock market, whatever. And because the government statistics NBR relies on are published at various lags, the NBER committee cannot officially designate a recession until after it starts and often not until it's over. So for instance, we shut down the economy in March of 2020. So it was open in February, shut down in March. Clearly there was recession, but they could not declare that until the confirming data arrived. Okay, so again, we're not in recession now. How could you be with consumers still spending and with so many jobs being created? But there are some signs. So for instance, for much of this pandemic recovery period, the mantra among many CEOs has been, let me chase demand. Economy's coming back very, very quickly. There's lots of unmet demand out there. If I can meet that demand, I hire the employees, I lease the warehouse space, I purchase the equipment, and I meet that demand, I gain that market share. And in an inflationary environment, I can monetize that market share. I can drive profits higher. I've got more room to push margins higher in an inflationary environment. But more recently, there seems to be more emphasis on cost containment. This comes from the US gross domestic product data, non-residential fixed investment in equipment. And you can see for the last 2 quarters, this investment has been in decline. Now, that could be in part because of supply chain issues. They're still lingering. So I spoke to a group of mechanical contractors recently out of Washington, D.C., and they told me their lead time to acquire switchgear, being for electrical equipment, was something like 50, 60, 70 weeks in many cases, in some cases 100 weeks, 2 years. They told me their lead time for generators was similar to that. So there's that. But I think this is because more and more businesses, more and more CEOs are deciding, I need to think about my cost structure. I took on a lot of costs during this pandemic recovery period. Maybe I hired too many people. Maybe I took on too much capital expense. According to a November 2022 PwC survey of US executives, 26% of firms are planning to reduce the number of full-time employees over the next 12 to 18 months. Now you can see from the employment data, there's still lots of hiring, but the plans are in place to maybe let some people go. In August of 2022, 50% of firms said they already had or had a plan in place to reduce overall headcount. And 4 out of 5 executives surveyed by PwC in November of 2022 said a recession is coming within the next 6 months. They're wrong about that. That was said 7 months ago. Recession did not come. But again, they're nervous. They're planning maybe for layoffs. In fact, some firms have already, of course, moved forward for layoffs. Here's some noteworthy layoffs in 2022, 2023. At the top of the list here is Amazon. The CEO there is Andy Jassy. Andy Jassy has announced 2 layoffs recently, the most recent being 9,000 jobs, totaling 27,000 jobs. But here's the thing. Andy Jassy did one other thing at least. He said to his white-collar workforce, you've got to come into the office 3 days a week. Yeah, that's right. You've got to come to the office 3 days in 1 week. Are we barbarians? Is this how we treat people? 3 days in the office? I can't imagine. Now, my guess is that was done to foment collaboration, innovation, supervision, but also try to get some people to quit, and some people have quit over that policy. Meta, the CEO there, of course, is Mark Zuckerberg. He announced a massive layoff, but during a recent earnings call, he said the words efficient or efficiency 41 times. He's declared this the year of efficiency at Meta. And so many CEOs watched as his share price rose 100% so far this year, at least until the last few days. And looking at Meta and saying, you know what, if that's how you drive up your share price, by cutting costs, by focusing on efficiency, maybe I shouldn't be chasing demand, maybe I should cut costs. And this shifting attitude in an interest rate driven environment is particularly impactful on interest rate sensitive segments like real estate. So let's talk a little about real estate. So this is from 1992, A Few Good Men, playing the part of Lieutenant Daniel Kaffee, a young military attorney. So I began this story talking about interest rates. I think that's the right place to begin. That's what's really shifted over the past year, the trajectory of the economy over the past year, but also going forward. So let me show you 2 interest rates of interest. The 15-year fixed mortgage rate here is in green, and the 30-year fixed mortgage rate here is in gold. Green and gold, of course, the color of money, which was the 1986 Tom Cruise film, also starring Paul Newman, playing the part of Fast Eddie Felson. In any case, in January of 2022, the average 30-year fixed mortgage rate, according to Freddie Mac, was 3.22%. According to the most recent weekly data, 6.79%. Now, some of you might say to me, Anirban, a 6.79% mortgage rate on a 30-year fixed is not a big deal. My first mortgage rate was 18%. My first mortgage rate was 15%. I've had people come up to me after presentations bragging about the fact that they used to pay 15% interest. I am not impressed. But it is an interesting history. And for those folks, 6.79% would not seem especially onerous. However, to millennials and Generation Z, preposterous. And that's who's really subtracted themselves from the would-be buyer market. It's that first-time buyer, the first-time move-up buyer, the more interest rate sensitive buyers. Now, as I move toward the tail end of this presentation, I'm going to show you a number of leading economic indicators because I want to pivot from a discussion of what's been going on to a discussion of what's likely to happen going forward. Now, the home purchasing process often begins with a mortgage application. So unless you're a private equity firm or a quite well-heeled American household, people typically have to borrow money to purchase a home. This is your U.S. Mortgage Loan Applications Composite Index from the Mortgage Bankers Association, the measure of loan applications. And it is down this index by 80% since its 2021 peak. And again, who has subtracted themselves largely from that marketplace? It's that first-time buyer, that millennial or Generation Z buyer. Generation Z is not quite old enough to be in prime home buying age, but they're getting there. Within 5 years, they will be there. But, it tells you the story. And predictably, with higher mortgage rates, we've seen some price adjustments. So this is the S&P Case-Shiller U.S. National Home Price Index. And you can see after a period of phenomenal growth in home prices, we saw some give back. Except that during the most recent month, home prices bounced a bit higher. I've been amazed by this. I would not have predicted the kind of strength here. Now, true, the inventory of unsold homes is very scant. So people are competing over very few homes. And by and large, all the entry-level or first-time buyer homes have been bought. So what's left is an inventory of quite pricey housing, as it turns out. And you see a lot of cash deals out there, and you still see some bidding wars. Now, again, there was a period during which home prices were in decline, particularly in certain markets. So I can break this down by metropolitan area. This is the S&P Case-Shiller Home Price Index by metropolitan area, 12-month percentage change. You can see some technology intensive markets like Seattle and San Francisco, also San Diego, giving back some home price gains over the last 12 months through March. But then you look at the bottom there, Miami, Tampa, Charlotte, Atlanta, again, the American South, with still some price gains. I mean, you would not know that interest rates have increased in Miami. I mean, there's so much cash pouring into that market from Russia, from Latin America, so on and so forth. So property has been very expensive there, as you know, getting more expensive. But here's the thing. So you see a mix here. But the next slide, you will not see a mix. The next slide is just the 1 month percentage change, just March of 2023 itself. So here you go. The 0% line is left-hand axis. Everything is gaining in terms of home price again. And you can make the argument the home market or single-family housing market has already bottomed out. It's already had its recession. There's still this appetite to buy homes. And I think one of the things that's happening here is that, people are always looking for diversification opportunities. I mean, they're in equities, they're in bonds, of course. S&P is trading right now at 4265.11. It's down about 18.59 points so far today, but it's been strong. It's been a strong performance. So people say, I've got some equity market gains. We'll see where the equity markets go. But to diversify my portfolio, maybe I should buy a property. So you see a lot of these all cash deals and, the homes at the upper end of the spectrum that do trade at handsome prices. Now, I want to show you another leading indicator, but this one relates more to construction of homes. This is U.S. residential building permits. That's a leading indicator because if you're a builder, you've got to pull a permit before you build. You see the yellow line there? That's single-family building permits. And that has been down recently until, again, a recent bounce back because home builders see, oh my goodness, housing market's holding up better than we thought. There's still some unmet demand out there. Permits have been actually pushing higher very recently. So again, I've been surprised by that. I would have thought that given that interest rates have risen so much and that they're set to rise perhaps even further, we'll see, that you'd see more permanent downward pressure on the single-family market. Actually, the market where we're seeing more weakness recently has been the multifamily market. If you look at that downward trajectory, that includes your apartment construction. And I would have thought this segment would have been stronger because you have to have a place to live, right? And all things being equal, higher mortgage rates are good for the apartment rental market, right? If you can't buy a home because of affordability issues, because of higher mortgage rates or lack of inventory or high prices generally, you're going to rent, right? Well, if you're a millennial, for instance, or if you're Generation Z, you're going to rent. But here's the thing that's happening. I think that this is really driven by the lack of access to capital among many developers. There's developers that pull permits. And what they're finding is that bankers in many cases are more reluctant to expose themselves to real estate fundamentals, dynamics. We've got like $1.5 trillion in commercial real estate related debt to refinance between now and the end of 2025, the so-called debt maturity wall. Who's going to refinance that debt? Who's going to finance more apartment building? Because people, bankers at least, are risk averse right now, given what's happened at Silicon Valley Bank, Signature Bank, First Republic, Credit Suisse, Deutsche Bank, more recently PacWest and Western Alliance. So there's still these banking issues out there. Now, this next measure pertains more to commercial real estate. It's the Architecture Billings Index. It's a reflection of how busy architects are. You see that 50-yard line running west-east across that slide? Any reading above 50 means that architects are collectively busier now than they were the previous month. And you can see that during much of the pandemic recovery period, architects were getting busier and busier and busier. Well, of course they were. The economy was coming back very strong and people were looking for income. You might remember that for a while there, interest rates were very low. So it's difficult to generate interest income, right? Bonds were not yielding. The last year, fixed income got its last name back. But prior to that, people were looking for other sources of income. And real estate is one of them because real estate generates rents and hotel daily room charges, that kind of thing. And that kept architects busy because properties being purchased and then repositioned in the marketplace, design, build. But since the past 7 months, architects have been getting less busy. And again, I think there's a big issue in commercial real estate. That, last year the US economy grew 2.1%. We added thousands, hundreds of thousands of jobs in white collar segments. And yet the US office vacancy rate rose last year as remote work stays pervasive. And this is misleading, this 12.5%. There's a lot more office space vacant than that, but it's not considered vacant statistically because it's still leased. But as these lease renewals come up, you're going to see a push higher. And there's another segment of commercial real estate that's in trouble, at least one. That's your malls, your shopping malls. This is vacancy rate in shopping malls. Yeah, consumers have been spending, but increasingly online is gaining market share. So, something like 1 in 4 malls is set to fail within the next 3 to 5 years. And we saw a lot of retail bankruptcy during the pandemic. So Brooks Brothers, Francesca's, Pure One Imports, GNC, all go bankrupt. And with that comes a lot of store closures, and many of those operate in malls. So watch out for commercial real estate as one of the real drags on the economy going forward, because these properties are simply not cash flowing sufficiently, and they've got a lot of debt against them, and somebody holds that paper. Okay, enough of that. Let's go to the forecast now, and then we can open for Q&A. Just give me about 3 or 4 more minutes here, and then we can go to Q&A. So it's a 2014 film, science fiction. Not my favorite Tom Cruise film in the interest of full disclosure, but an amazing transition slide. So it makes the cut. Now, you cannot have a recession unless the consumer participates, because they're about 70% of aggregate demand. So as long as the consumer is spending, no recession, by and large. So one of the things that we do is we monitor their psychology. Are they happy? Because the theory is that if they're happy, they're more likely to spend. So this is the University of Michigan's Index of Consumer Sentiment. Where is the consumer right now psychologically? They're miserable. And what has them so miserable? More than any other factor, it's inflation. They're roughly where they were in 2008 psychologically, in the midst of the global financial crisis. They're angry about it. People ask me all the time, Anirban, why do people drive angry? Because they're angry, generally speaking. And they're not the only ones who become quite pessimistic. So I talked about the PwC survey data, and that largely relates to large corporate CEOs. You can see the consumer is sort of downcast, downbeat. Small businesses too. This is from the Nash Farage Impact Business Index of Small Business Optimism. Question Small Business America, is it a good time to expand your business over the next 3 months? In April, only 3% said yes, akin to where we were in 08 or 09. And they would like to expand their business, mind you. They live for that, but they can't find workers, can't retain workers, can't afford workers, can't afford their healthcare premium. They suffer equipment delays and shortages. Their materials prices have gone up. So concrete prices, as an example, are up 13% over the past year. So is it a good time to expand? Many of them would say no. Now, these are considered soft data. The psychological data, survey data. This is a bit harder. This is the US Leading Economic Index from the Conference Board. It's 10 leading indicators all bundled into one indicator that I'm graphing for you here. Actually, Sarah Niblett from our staff graphed here. Now, this is an index that predicted the 2001 economic downturn, predicted 07, 08, 09, and now it's telling us tougher times are in front of us. The economy has been stubbornly resilient so far, but there's a lot of lag effects in the economy. There's tightening credit conditions. Consumers have taken on a lot of debt. They're not happy with life as a general proposition. And so, these measures, at least taken collectively, suggest to me that recession is quite likely. You've got an inventory cycle working against us. This is business inventories. So look at the slice in the middle there. That's the green slice. That's retail inventories. I had mentioned that retail sales actually fell in November, December, then again, February, March. There's been lots of discounting. Maybe you heard some negative things from Home Depot and Target lately. Again, the middle market. And so when retailers see that they have to discount merchandise to move it, they order less from the merchant wholesalers. That's your distributors, your middlemen and women. Their inventories have risen. You can see that. And when they see their inventories rise, they order less from the manufacturers. That light blue down below. Manufacturing inventories are up. And if you look at the Purchasing Managers Index, which is from the Institute for Supply Management, it's one of the favorite leading indicators for economists. The manufacturing indicator is sitting at 46.9. Well, that's below 50. That means manufacturing is now in retrenchment. So again, all of these measures suggest recession is quite likely. This one screams that recession is coming. This is your U.S. Treasury yield. It's your yield curve. Again, 2 interest rates of interest. The yield on the Treasury is the National Treasury. The yield on the 1-year Treasury. That's my artificial intelligence going on. The yield on the 1-year Treasury is in gold. The yield on the 10-year Treasury is in green. So typically, you'd expect the interest rate or yield on a 10-year instrument to be above that on a 1-year instrument. If I were to buy a U.S. Treasury, thereby lending to the federal government for 10 years, I'm not going to see my principal for a decade. I'm going to demand more interest in the interim per annum to reward me for my patience. Conversely, if I buy a 1-year U.S. Treasury, I'm going to see my principal in 12 months, risk-free. Now the debt ceiling is behind us. And so I don't need to be so richly compensated. But occasionally, the bond market goes topsy-turvy, upside down, inside out, Diana Ross. And the gold line, the yield on the 1-year, goes above the green line, the yield on the 10-year. These gray shade areas are periods of recession dating back several decades. So where do you see the gold line go above the green line, this yield curve inversion? Just before the 1970 recession, before 73, 74, 75, before 1980, before 81, 82, before 1990, 1991, before 2001, before 07, 08, 09, not so much before 2020, that was caused something else, but now we have massive inversion of the yield curve as it got up here about 1.4 percentage points in terms of that inversion. It's screaming recession. I think recession is coming, and maybe you can't handle the truth. Now, you might say, Anirban, a couple of things. First of all, it's not the truth, it's your forecast. Now, you just said that the economy is not working out the way you expected. Fair enough. This is not about you buying into my forecast, not at all. I'm agnostic with respect to that. My goal today has been to do some issue spotting on your behalf, look at some of the economic risks out there so you can think about your portfolio and other aspects of your economic life. You can refine your own outlook for the economy. I mean, you might also point out to me, that wasn't said by Tom Cruise, sir. That was said by Jack Nicholson, 1992, A Few Good Men. Fair enough. Jack Nicholson played the part of Colonel Nathan Jessup, and he's on the stand, and he's being grilled by a young military attorney, Lieutenant Daniel Caffey, who eventually asked him a question that elicits this response, which is an admission of guilt. And that young military attorney, Lieutenant Daniel Caffey, well, that role was played by one young and quite handsome Tom Cruise. I think the economy gets worse before it gets better. Now, you might see a bit of a bounce back in second quarter gross domestic product because, again, the first quarter was weakened by inventory decumulation. You might see some inventory rebuild during the summer spending months. Again, we're in the last month of the quarter, as it turns out. But then I think the weakness comes later in the year. In fact, I think the recession begins September 5th. They say, Anirban, check out. At no point have you demonstrated enough insight to forecast that with that level of specificity. I don't disagree. But what is September 5th? It's the day after Labor Day. And I think that's when it really catches up to us. That consumers will continue to spend and travel during the summer months, but come Labor Day, after that weekend, they look at their credit card balances. Some have to start paying back their student loans. That's when recession begins. And I think we're going to see more layoff announcements between now and then. The global economy is weakening, which is reinforcing our economic weakness. Our economy is weakening, inventory cycle, so on. Borrowing costs are higher, that's incontrovertible, and excess inflation persists. Some segments and hold it better than others, including public construction, grocery stores, and multifamily housing, at least from the perspective of leasing. You got to eat, you got a lot of money lined up for infrastructure, need a place to live. And at some point, the Federal Reserve will stop raising rates, and as importantly, will start lowering them. Now, the bond market's saying different things, but now the bond market seems to be agreeing with the notion that they won't start reducing rates until 2024. So we'll see. And that will spawn the next growth cycle for America. But until then, I think recession conditions are set to prevail at some point in the next 12 months. I think actually a bit sooner than that. Of course, again, I could be wrong. I am an economist. With that, thank you very much to CJM for the opportunity to be with all of you today. I'll stop sharing and we'll turn it over to Q&A.
Thank you. That was excellent. Did have a question come through. How does wealth disparity in society affect the various charts that you presented? Is there a large percentage of the population that doesn't have dispensable income to participate as they may have been able to?
Yeah, as I pointed out, those inflation is particularly high in those categories that would most impact the people in the lowest quintiles of income, food prices, for instance, and also shelter prices. Yes, I mean, we have an incredible number of Americans who depend exclusively on, for instance, Social Security for their income. About 40% of people receiving Social Security depend on that exclusively for their retirement income. It's not meant to be that. It's meant to be an income supplement. Again, 40% depend exclusively on that for their income. We obviously, a lot of the savings generated during the pandemic from stimulus payments, foregone vacations, so on and so on, that money has been spent down. So during the peak, as it turns out, we had about $2.3 trillion in excess savings at the household level. So again, foregone vacations and other experiences, and stimulus payments, all of that. 2.3 trillion in excess savings means what? Above and beyond what would have transpired but for the pandemic. About 1.3 trillion of that has been spent already. So we're down to $1 trillion in excess savings, but a lot of that $1 trillion is held by people in the highest quintile of income. So people at the lowest quintiles of income have spent through those savings, the credit card balances are rising, many of them now have to restart paying student loans. You put all that together, you're going to see in that lowest quintiles of income, let's say the lowest two quintiles of income, a lot of pressure, especially if I'm right, that the labor market softens during the months ahead.
Thank you. Did have a question about the debt ceiling, which they did kind of wrap up on Saturday. What is the impact on the economy here in the US and relations with other world countries if they just keep with the political infighting as they renegotiate this every couple of years?
Yeah, I mean, I don't think it helps America. It said the markets hate uncertainty, and this is a source of uncertainty. But one has to say that the markets do not seem particularly roiled by this, right? Neither the bond market nor the equity markets seem to take this very seriously. And the equity markets were rising for the most part as they reached that agreement. There was the presumption they're going to reach that agreement. Once they reached the agreement, the market gave back a little. You might know because you buy the rumor, you sell the news, and so the presumption was they were going to make an agreement. It was catastrophic. They weren't going to do it. It's election year next year, and incumbents want to be reelected. If you want to be reelected, you don't want to create an economic crisis. So, but in January 2025, apparently we're going to revisit this, and we'll see what that looks like. But by that point, we have a new president and all those kinds of things. So very different dynamics. Actually, we might have the same president specifically reelected. Let me be clear about that. But it'll be a new presidential administration, one way or the other.
Yes. The question around cryptocurrency with the Fed and potentially banks looking at issuing their own currencies. Should we be concerned about that at all?
Oh, I don't think we should be concerned necessarily unless we're owners of Bitcoin or something like that. Because here's the thing, I'm often told by young men, like 27 years old, who are the leading advocates of Bitcoin. It's digital gold, man. They'll say first, it's digital gold, man. And I'm like, don't call me man. But then I'm also like, why do you say that? They say, well, it's the currency of the internet. I said, well, I mean, my credit card works on the internet. My PayPal works on the internet. What do I need digital currency for or cryptocurrency? So what is the difference between cryptocurrency and digital currency? Digital currency comes from governments, right? It's government-backed, government issued. And so the Treasury Department has been researching for a couple of years now their own U.S. Digital currency, which could actually compete with Bitcoin and Ethereum and all Litecoin and Ripple and so on and so forth. So I think that as you see these governments put forth these digital currencies, that's going to create more competition for Bitcoin and so on and so forth. And so with the SEC coming down on Coinbase and other companies, all this regulatory uncertainty, and with more competition coming from governments in this space, that's why I'm concerned about the long-term value of Bitcoin. Look, Bitcoin is 27,000, 26,000, whatever it is today. But anyway, I'm not worried about it. But I would be thinking about this if I had made a lot of money in cryptocurrencies about whether I would continue to.
And a question around the recession that's going to start on September 5th. How long do you think it will last and how deep do you think it will be?
Yeah, I think it'll be actually a quite shallow recession. I'll tell you why. It's because we've already had these rolling recessions. As I mentioned a little bit about this, you've seen some retrenchment in the technology sector. Big tech has already announced some serious layoffs. You've seen the housing market maybe even bottom out already. And so some of the imbalances that have been in the economy have already been worked out even before we enter an economy-wide recession. So I think the recession is going to be quite mild. And I think the Federal Reserve is going to come forth with interest rate cuts in 2024. And so, the economy is going to weaken for a time, but I don't think it's going to be a very lengthy time.
Okay. And I have one last question, and we'll end kind of hopefully on a positive note. What are the top factors that are actually keeping the economy steady right now, which you did cover a little bit throughout the presentation?
I would say it's lag effects. I mean, that's what this has been about, Parker, lag effects. That's why it's not very interesting. But you've had all these things take place in recent years. So for instance, you've had these the interest rate increases, but before that you had interest rate decreases. Stimulus has taken some time to work through the economy. You had all that fiscal stimulus, whether under the Trump or Biden administration, right? American Rescue Plan Act signed by President Biden March 11th of 2021. The Infrastructure Investment and Jobs Act signed by him on November 15th of 2021. Before that, it was the CARES Act signed by Donald Trump, March 27th of 2020, $2.2 trillion package, Consolidated Appropriations Act, signed by him on December 27th of 2020, $906 billion in stimulus. So this stimulus is still working its way through the economy, along with all that previous monetary stimulus. But now what you're seeing is the stimulus is starting to go away. The fiscal stimulus is starting to wane in terms of its impact on the economy. And now, of course, more recently, we've had interest rate increases. You've got all those negative lag effects now built into the economy. That's why I think the economy gets worse before it gets better. That's why I'm predicting recession. And maybe it's not September 5th. It could be maybe the 6th or the 7th.
Okay, thank you. That actually wraps up all the time we have for today. I really appreciate your time, Dr. Basu, and the insight and the entertaining presentation for today. At CJM, we have a big focus on education and just kind of awareness of what's going on. And hopefully today's presentation helped fulfill that, our goal there. And appreciate everyone kind of sitting with us as we try a new format here on Zoom versus an in-person meeting as well. Again, that's all the time for today. Thank you all so much for your time, for joining us. And feel free to reach out if you've got any feedback or any questions that we didn't get answered for you today that we can maybe answer sometime in the future. That concludes the presentation, and we'll see you all sometime soon. Thank you.
Thank you.